If you've been wanting to invest but don't know where to start, this is for you. Today, we're breaking down 5 of the most popular ways people grow their money: real estate, index funds, individual stocks, cryptocurrency, and gold. I will be explaining what makes each one different, how risky they are, how taxes work, and how much you could earn. In the end, I will rank them from the easiest to the most challenging, so make sure you stay tuned until the end of the video. Index funds. If you're after something simple and beginner-friendly, this is it. An index fund is basically a collection of stocks designed to mirror the performance of a market index, like the S&P 500. So instead of picking individual companies, you're investing in hundreds of them all at once. The beauty here, the learning curve is low. You don't need to be a stock market expert or track earnings reports. It's what I call a set-it-and-forget-it investment. You drop your money in and let the market do its thing. As for passive income, you'll earn a little through dividends. Those are small cash payments companies make to shareholders, but the real win is long-term growth. Index funds tend to grow steadily over time, especially if you reinvest those dividends. Tax-wise, super efficient. They don't trade much, meaning fewer taxable events. And if you hold them inside a Roth IRA or 401k, you might not pay taxes at all until retirement. When it comes to risk, it's low to moderate. Sure, markets drop now and then, but since your money's spread out across tons of companies, the ups and downs balance out over time. Individual stocks. Now let's talk about investing in individual stocks where things get a little more hands-on. Buying individual stocks means you're purchasing shares of a specific company like Apple, Amazon, or Tesla. Sounds exciting, right? But it comes with a steeper learning curve. You'll need to read financial reports, watch market trends, and sometimes make fast moves based on news or earnings. The passive income potential? It can be solid. Some companies pay regular dividends, while others might grow dramatically in price. Think about the people who bought Apple years ago. Huge gains. But it can also go the other way just as fast. On the tax side, you'll pay on dividends and profits when you sell. And here's the catch. If you sell a stock within a year, your profit is taxed as regular income. If you hold it for a year, you'll qualify for long-term capital gains tax, which is typically a lower rate. And the risk is very high. Unlike index funds that spread out your risk, you're putting your money on one company. One bad earnings report, one scandal, one market crash, and your stock could drop overnight. Cryptocurrency. Now for the wild card. Cryptocurrency. If you've heard of Bitcoin or Ethereum, you already know how wild this space can get. Crypto is digital money that runs independently of banks and governments, using something called blockchain technology. The learning curve is a bit steep. You'll need to understand wallets, exchanges, blockchain basics, and how to keep your coins safe from hackers. And trust me, this industry moves fast. Passive income potential is surprisingly decent though. Some people make money through staking, lending, or simply buying and holding until prices rise, but it's unpredictable. A coin worth $50,000 today might be $20,000 next week. Tax efficiency is not great. The IRS treats crypto like property, so every time you sell, trade, or even spend it, that's a taxable event, and tracking it all can be a headache. Risk-wise, extremely high. Prices swing wildly. One tweet, one regulation announcement, and the market can crash. It's a gamble, which is why I personally think it should be a small part of your portfolio when you're starting out. Real estate investing. When people hear investing, real estate is usually one of the first things that comes to mind. Why? Because you're buying something tangible, a house, an apartment, a building, and if you play it right, it can be one of the most powerful ways to build wealth. But here's the thing. Real estate isn't as easy as just buying a house and cashing rent checks. The learning curve is real. You've got to learn about neighborhoods, market cycles, financing options, and local laws. And once you own a property, there's property management, repairs, dealing with tenants, and those surprise expenses that pop up when you least expect them. That being said, the passive income potential here is huge. Rental properties can pay you monthly through rent, and over time, the value of your property typically goes up. This is why so many millionaires make real estate part of their portfolio. And when it comes to taxes, real estate is one of the most tax-friendly investments in the US. You can deduct mortgage interest, maintenance costs, insurance, and even depreciate the value of your property to reduce your taxable income. There's also something called a 1031 exchange that lets you sell and reinvest without paying taxes immediately. But real estate comes with medium to high risk. Property values can drop during market downturns, tenants might miss payments, and emergencies, like a busted water heater, can eat into your profits fast. Plus, it's not easy to sell a house overnight if you need quick cash. It's what we call illiquid. And finally, let's talk about gold. People have been investing in gold for thousands of years. It's known as a safe haven asset because it tends to hold value during market downturns. The learning curve is low. You can buy physical gold ETFs, or shares in mining companies. Pretty straightforward. Gold doesn't pay dividends or interest. You're simply hoping the price will rise. Physical gold is taxed as a collectible, which usually means a higher tax rate than stocks when you sell. Gold ETFs have different rules, but can still trigger taxes. The risk is low to moderate. Gold won't typically crash, but it also won't skyrocket like stocks or crypto. It's more of a wealth preserver than a wealth builder. So if you're looking for a way to protect your money rather than aggressively grow it, gold is one of those classic, steady options worth considering. It won't make you rich overnight, but it can help you sleep better when markets get shaky. Let's rank them from easiest to hardest. Alright, based on everything we've covered today and just from my own perspective, here's how I'd rank these 5 popular investing methods. Number 1. Index funds. This is hands down the simplest, most beginner-friendly option out there. You don't need to pick individual companies or time the market. Just put your money into a broad market index like the S&P 500 and let it grow over time. Historically, the market trends upward in the long run, and with index funds, you're basically betting on the economy as a whole. I advise that you set up automatic monthly contributions and reinvest your dividends. It's a true set-it-and-forget-it strategy for building wealth steadily. Number 2. Gold. It's not a huge income generator, but it's great for protecting your money against inflation and market crashes. The learning curve is super low. You can invest through ETFs, physical bars, or even digital gold platforms. Pro tip: use gold as a small part of a diversified portfolio. Think of it like insurance, not a main wealth builder. Number 3. Individual stocks. Now we're getting a little spicier. Picking stocks can be exciting, but it takes research, patience, and a strong stomach for ups and downs. You can make big gains, but losses happen just as fast if you're not careful. Advice: start small with companies you understand and never invest money you can't afford to lose. Also, consider using stock simulators first to practice without risking real cash. Number 4. Real estate. This is where the potential gets real, pun intended. Real estate can offer tax benefits, rental income, and long-term appreciation. But it's very hands-on, requires a decent amount of capital up front, and comes with responsibilities like tenant management, maintenance, and market research. Pro tip: if you're short on funds, look into real estate investment trusts as a way to get in the game without owning physical property. Number 5. Cryptocurrency. Last but definitely not least, crypto. This one's a roller coaster. The learning curve is steep, the market moves 24/7, and prices are wildly volatile. There's big upside potential, but it's risky if you jump in without understanding how blockchain, wallets, and market cycles work. My advice: never invest based on hype. Start by learning the fundamentals: Bitcoin, Ethereum, how exchanges work, and only risk what you're fully prepared to lose. At the end of the day, every one of these investments is just a different path to the same destination: financial freedom. The trick is finding the one that fits your lifestyle, risk tolerance, and goals. Because money isn't loyal to people who just save it, it grows for those who put it to work. So pick your lane, stay consistent, and let time do the heavy lifting. That's all for today's video. If you found this helpful, hit that like button and subscribe for more videos like this. I'll see you in the next one. Stay smart, stay invested.